In this video, we will discuss how to complete the operating section of the statement of cash flows using the indirect method. Remember that operating cash flows are cash flows relating to the company's calculation of net income, including revenues and expenses. The idea behind the indirect method of calculating operating cash flows is to start with net income, which reflects all revenues less any expenses the company had in a period, and then adjust it to reach operating cash flows. There are two different types of adjustments that we need to make to net income. The first type is for a few specific income statement related items. We must first adjust for expenses with no cash outflow. Examples include depreciation or amortization expense. These expenses should be added back to net income on the statement of cash flows. The second type of income statement item adjustment is for a few specified gains and losses that do affect cash but are not related to operating activities. These include things like the gain or loss on the sale of plant assets or the retirement of debt. Losses should be added back to net income and gains should be subtracted from net income. Here we have a simple example to demonstrate what we have discussed so far. So we have a template for the statement of cash flows, and then we have an income statement over here. In the first step in the cash flow from operating activities section is to find the net income, which is at the end of the income statement. It looks like it's $5,000. So we put the net income as $5,000. Next, we move on to the adjustments to net income, and we have the income statement items that are not affected by cash. The first thing you'll want to look for is the depreciation expense, and we can see that's right here for $4,000. So we'll type depreciation expense for $4,000. Next, you'll want to look for gains or losses that are not related to operating cash flows. Over here, we see the gain on sale of equipment, which is really related to investing activities, not operating activities. So we will have to adjust for that. So we have gain on sale of equipment, and since that's a gain, we have to subtract it. So that's negative $2,000. Note that the title, Income Statement Items Not Affecting Cash, is typically what you will see on the statement of cash flows, but a more accurate title might be Income Statement Items Not Affecting Operating Cash Flow, as items like the gain on sale of equipment do actually affect cash, but they are simply listed in the incorrect section of the statement. And if we take a look at the income statement, we can verify that we have taken care of all of the non-cash expenses and gains or losses unrelated to operating activities. So we would be finished with the first part of the operating activities section of the statement of cash flows and ready to move on to the next part, which we will discuss now. The second type of adjustment we need to make to net income is for changes in current assets and current liabilities. You might be thinking, wait just a minute, what do current assets and liabilities have to do with operating cash flow? I thought we were only interested in things that affect net income. Well, it just so happens that current assets and current liabilities are related to revenues and expenses that are found on the income statement. For example, the current asset accounts receivable is related to sales, which is a revenue account. The current asset inventory is related to cost of goods sold, which is an expense account. Income tax payable, which is a liability, is related to the expense income tax expense. And even more importantly, it's only when the balances of these accounts change from one period to the next that we need to make an adjustment to net income. So here are the rules you need to memorize, which are summarized in this chart that I'm drawing. If a current asset increases from one period to the next, the change should be subtracted on the statement of cash flows, which I have indicated here with a subtraction sign. If a current asset decreases from one period to the next, it should be added on the statement of cash flows, which I have indicated here with an addition sign. Think opposites for current assets. Subtract the increases and add the decreases. For increases in current liabilities from one period to the next, the increase should be added to the statement of cash flows. If a current liability decreases from one period to the next, it should be subtracted on the statement of cash flows. Think the same for current liabilities. Add the increases and subtract the decreases. But why do these rules work, you might ask? What are they doing? Remember that our goal is to find instances where cash and net income are different and reconcile the difference. Let's just think about accounts receivable, which is a current asset. If the accounts receivable balance began the period with $30,000 and ended the period with $40,000, that's a $10,000 increase in a current asset, which means the rule from the chart earlier says that we should subtract $10,000 on the statement of cash flows. Let's say credit sales are $100,000. The amount really doesn't matter. In order to get the ending balance of $40,000 in accounts receivable, we know there needs to be a $90,000 credit to accounts receivable. And we know accounts receivable gets credited when cash is received from customers. The point here is the difference between the beginning and ending accounts receivable balances is the same as the difference between sales and cash receipts. They are both $10,000. So, remember, our goal is to reconcile the differences between net income and cash, and we found one. Net income is increased by $100,000 through sales, but cash is only increased by $90,000. So we have to subtract $10,000 from the change in net income to get to cash. That's exactly what the rule from the chart told us to do. And the same logic will work for any current asset or liability. Another logic can be a little bit confusing, but the most important thing you need to remember in order to complete the statement of cash flows is this chart. So make sure you have it written down in your notes. Let's continue with the example we started earlier. We just discussed the next section within the cash flows from operating activities, which is for changes in current assets and liabilities, which I have labeled here. Note that sometimes changes in current assets and liabilities and income statement items not affecting cash will not be separately labeled on the statement of cash flows. Over here I have a balance sheet which has the prior year of 2019 and the current year of 2020. And we need to pick out the current assets and liabilities. So our first asset is cash, which of course is a current asset, but since the entire statement is about cash flows, we actually don't include that in this section, so we can skip over cash. Accounts receivable, on the other hand, is a current asset that we will include, so I'm just going to highlight that for now. Supplies is also a current asset, so we will include that. Equipment is a long-term asset, so we are not going to include that. The accumulated depreciation is related to the equipment, so we can skip over that one. And land is also typically long-term, so we will not need to include that either. Next, moving on to the liabilities. Accounts payable is a current liability, so we will need to include that, so I'm just going to highlight it. And bonds payable is a long-term liability, so we will not need to include that. Note that there are a few exceptions of current assets and current liabilities that should not be listed in this section, such as notes payable or notes receivable, but we don't have any of those exceptions in this problem. Now remember, we are interested in the changes to current assets and current liabilities. So let's first start with accounts receivable. We can see that there was a $29,000 balance in 2019, and in 2020 there was a $23,000 balance. So the difference between those two numbers is $6,000. So that tells us that there was a $6,000 decrease in accounts receivable. So that's exactly what we're going to put on the statement, a decrease in accounts receivable. Now here's when you have to revisit that chart. So if we have a decrease in a current asset, like accounts receivable, the chart tells us that we actually have to add that back to the statement of cash flows. So the amount of the decrease was $6,000, so we're going to add $6,000 on this statement. Next we have supplies, which had a $3,000 balance in 2019 and a $5,000 balance in 2020. So that's a $2,000 increase from 2019 to 2020. So on the statement we will put increase in supplies. And since supplies are current assets, we're going to have to subtract that amount on the statement of cash flows based on our chart. So we will subtract $2,000. Next we can move on to our only current liability, which is accounts payable. And we can see here it went from $21,000 in 2019 to $18,000 in 2020. So that's a $3,000 decrease. So we're going to put decrease in accounts payable. And since accounts payable is a current liability, when we have a decrease, we are going to subtract that based on the chart. So we'll have negative $3,000. Alright, our next step is to find the total. So we take the $5,000 from net income, plus $4,000, minus $2,000, plus $6,000, minus $2,000, minus $3,000, and we should get positive $8,000. Now the reason why I found this total before I actually put the label on it is because the label is going to depend on whether or not this number was positive or negative. So in this case we have positive $8,000, so we will put net cash provided by operating activities. And if this would have been a negative number, we would put net cash used by operating activities. Alright, that wraps up the operating section of the statement of cash flows. The next video will discuss the investing and financing sections of the statement of cash flows.